Dear students, today we shall discuss management decisions, especially make or buy. So, first question comes to our mind that what management decision means. Now, in simple term, management decision means management has to take several decisions, right? Some of the decisions may be related to finance, which you call financial decisions, like your capital structure, like your dividend policy, like when the company is to issue bonus shares or the company going for buyback of shares, what are the tax implications? That is one part. Second part is certain specific management decisions, right? In that case, you may argue that these are basically the domain of the capital budgeting, which you must have done in financial management. We agree. That is basically it's a capital budgeting. But one very small thing is that there are some tax implications also, because in case of capital budgeting you have also seen that tax implications like when tax benefit on depreciation, tax benefit on interest, or when you sell an old asset, right, at the end of its life and you are purchasing a new asset, at the end of its life there may be a short-term capital loss or the short-term capital gain, right? If it is a gain, it is taxable, right? So some tax implications are there. So here we will focus only on those tax implications, nothing else. Another small thing is whenever you go for the decision making, there are several tools are there, but one of the important tools is the net present value, which is the difference between the inflow and the outflow. Now here lies a very interesting question. Yes, sir, outflow I am making in year 1, but inflow it will take say 5 or 6 years. I will get some inflow from that asset. Now how will I compare it? That's where you need the concept of the discounting so that you can get the present value today. So today you know your outflow present value, then you deduct it and you get the net present value, right? Now the specific thing is make or buy. Now what is make or buy? Suppose then there is an option, because you will appreciate in some of the industries they make something, they buy something. I will give an example. Say the car industry. Car industries, they are making cars, but basically they buy tires from other companies, they buy battery from other companies like Exide or Amaran, and say maybe buying tires from the Seat or any other Apollo, right? So now the question is, when a company take a decision whether these items are to be manufactured or these items are to be purchased, right? So now this is basically, if you have an exposure in the cost and management accounting, you can grab, so these are the areas which I did in the management decision. Yes, agreed. Absolutely agreed. That is the basic case. That in case of make or buy, what happened? I basically compare the cost of manufacture of that unit, the variable cost of manufacture of that unit, and the purchase price. Accordingly, decision has been taken. Or in some cases, suppose the decision has to be taken whether the product has been manufactured or the product has to be purchased. Now that product uses a machine, right? And if you don't do the product, this machine can be used for other purposes. So in that case, what we do, we take the variable cost of production plus the opportunity cost of using the machine. So that compared with the purchase price. Now that is basically the concept under the CMA. But from tax point of view, I will discuss certain other things. So please this bear in mind. Now in case of make or buy, what happens? In case of make, there are two ways. Number one, you have a machine which you can use for manufacturing of that product. You need not have to purchase another machine. But there may be a situation when if you wish to produce this product, you may have to purchase another machine. So the tax implication will be different for the two. So once again, mind it, I will move one by one. In this case, when there is an existing machine and the excess production can also be done with the help of the machine, you need not have to incur any other expenditure. So what happens in that case? A very simple thing. It is once again the marginal cost of producing the unit. I will compare with the purchase price and the lowest should be taken. Suppose, say the marginal cost of producing that unit is say rupees 7, and that I can purchase from the market at 7.20. So if it is 7 is lower, so I will manufacture, and if I can procure at from 6.80 and my manufacturing cost is 7, so I will procure, right? But if any additional expenses, fixed expenses need to be incurred, that has to be considered. Second one is when you are manufacturing but that needs a new machine, or you need to establish a separate unit. Now what happens in that case? Now, in that case, you will compare the marginal cost of making the product plus the additional cost in the form of depreciation, right? Because you will appreciate whenever you are purchasing an asset, there are additional cost of depreciation which will be included as a part of your cost. So additional depreciation per unit has to be included, and then that is to be compared with the purchase price, and the lower should be taken, right? Now whenever you purchase an asset, something has to be considered that is very important, because whenever you are purchasing an asset and you are claiming a depreciation, and you know that under Income Tax Act, for an asset purchased, I can claim depreciation, one can claim additional depreciation, as well as in some cases 32 AD. So everything has to be claimed. Whenever you are computing this tax benefit has to be considered, right? And whenever you are establishing a new unit somewhere, so you got to consider the places where if you start your business in those places, you can have a tax benefit. Like if you start a business in an SEZ, you can get the benefit under Section 10 AA. Or if you started a business in a notified backward area of certain specified state, you can get an enhanced rate of additional depreciation. You can get 32 AD, right? And 80 IE. If you started business in northeastern region, you can get the 80 IE. So whenever you are purchasing an asset, you must consider those benefits which are available under Income Tax Act in form of 32. And plus one small point always that has to be considered, which I failed to bring you on notice in the earlier one. Mind it very carefully, there is a very interesting amendment has been made in 32, that whenever you are purchasing an asset and if you pay more than 10,000 other than by account pay check or by electronic transfer, so that will not be treated as a part of your cost. So don't pay more than 10,000 by cash or by via a check. In that case, it will not be considered as a part of cost. So these are the very, very important, another important aspect, that mode of payment, how will you pay, right? So whenever you talk of asset, don't pay this, you try to claim 32, normal depreciation, additional depreciation is 32 AD. And whenever you are making a business in a place, always think of the places where you can have some tax benefits. Thank you.